Hello and welcome to the Wise Money Guys radio show. I'm your co-host, John Scambray, and I'm here with my fine partner,
Giuseppe Visconti.
If you want to get a hold of us or come in for a no obligation consultation, you can give us a call at 916-967-3500. Basically until our next live dinner seminar for people who are retired or about to retire. You'll want to attend our April 29th free dinner workshop it's in Walnut Creek at Diablo Hills Golf Club. So call us at 916-967-3500 again to register for our Walnut Creek seminar on April 29th at Diablo Hills Golf Club. And we don't talk about it enough, but we're going to be talking about how to use leverage to grow wealth or increase assets, which real estate investors have been using for decades and decades.
S&P and NASDAQ on tax day, actually, April 15th.
I was saying,
ironically enough,
this will be a V shape, and that these dips were buying opportunities. I've been saying it every show.
And then a couple stocks that just tagged along with the AI frenzy, and we'll talk about what they did.
That's the laughable part I was talking about.
How they pivoted, how they rebranded themselves, and how that impacted their stock
which
price.
is eerily similar to what I call the iCrap.com era
Back
in the 90s.
90s.
Yeah, late 90s when.
So Allbirds, their old business was Sustainable Wool Sneaker Company. Okay,
whoa. So we're talking about AI right here. But this is a sneaker company.
Right. Yep.
Tennis shoes.
Yep. And their peak was at like $4 billion in valuation, which was in 2021. Then they rebranded themselves from Allbirds to Newbird AI. Okay.
Oh my God.
And their pivot is to go into AI compute infrastructure, buying GPUs for GPU as a service leasing.
Yes.
So what happened to their stock?
Yeah.
Their stock surged 582%.
Oh my God.
Yeah,
just like this new bird.
Right.
It's, if you got a 500% capital gain and you don't at least lock in 99% of that profit, in my opinion.
Or a big portion.
Right. So think about that. They were making tennis shoes.
Yeah.
Now they just say, we're going into AI. What type of AI? Are they actually going to create chips?
No, infrastructure, and they're going to buy GPUs, and then
and have some sort of
GPU as a service
competitor to chat.
Just lease it out.
Just lease it out.
Yeah. In one day, on Wednesday, jumped from a valuation of 21.7 million, okay, to 159 million in one day. Their market cap.
And did their revenue jump? Did their earnings jump? Did their profitability jump?
AI will take care of all of that. Don't worry about it.
But I guarantee it will be a good use of your time if you're retired or about to retire on April 29th from 6 to 7:30 p.m. That's a Wednesday at Diablo Hills Golf Club in Walnut Creek. Take some of your money, at least your principal, off the table. If you have something that goes up 500%, 150%, if it still has legs, greedy pigs get slaughtered. And it happens over and over and over again. If you're sitting on the New Bird or the Myzeum and those went up, again, consult your advisor when the uncertainty of going back to work had dominated the news. That was just a news-driven, fear, sensationalized, increase in stock price.
So JP Morgan, Goldman Sachs, Citibank, Bank of America, and they all beat and exceeded their estimates. So revenue and earnings per share. Now, all of the CEOs, Jamie Dimon for JP Morgan, David Solomon for Goldman Sachs, Jane Fraser, Brian Moynihan for Citi and Bank of America, all of their commentary basically was a resilient consumer spending environment and healthy businesses, a soft landing scenario. If earnings continues to prove favorable, especially a lot of the big names. So we'll have some big names next week, Texas Instruments, Intel. There was a whole slew of them. And then we'll obviously have, the big names like all the tech, everybody focuses on NVIDIA and Microsoft and so on. So if they continue to meet or beat expectations, that's going to create a nice buffer zone.
So many people think diversification is having multiple firms where you have accounts. That's called firm diversification, which is not diversification. And then having multiple fund companies, different brands of mutual funds or ETFs, and assuming that you're diversified that way. The simple fact of the matter is when it comes to not putting all of your eggs in one basket, it's very hard to know what that is. What it is you're doing is proper diversification when you use funds or ETFs or have money at multiple firms where one advisor or one firm doesn't know what the other advisor or the other firm is doing. Don't overbet on any one investment. We like to use a rule of thumb. It's a rule of thumb. Buy a 5% position or maybe even a little less. Don't go betting 10, 20, 30, 50% of your money on one investment
on new birds.
On new birds. And if you did and you went up 542%,
congratulations.
Please sell for profit.
Now if you're back up to where you were and maybe you're a little heavy in stocks or riskier assets, you can rebalance now, right? This is your opportunity. This is your chance.
The thing that I love that you can do with investments and assets of any kind is use leverage to potentially buy more assets or investments of any kind. And as long as the properties continue to cash flow, pay a positive cash flow above the cost of the debt, they'll keep doing that.
It's like rich dad, poor dad, right?
It's exactly right. They're using leverage. The strategy that many of our clients have used over the years is to borrow against their investments, way lower than a typical 30-year mortgage, right, to 6.14%, very in line with a typical mortgage, depending on, the asset, the collateral capability of the asset.
That way they didn't have to sell anything from their assets. Gave them enough where they actually took $900,000, bought their home in Arizona. They actually saved on some of the closing costs because they didn't have to go through all the lending. They didn't have to pay any they were about to pay some fees, some origination points or origination fees on the loan that they were going to be set up with, but that was gone. So they're able to save on some of the costs associated with that. It was very easy. It took them about 2 weeks to get everything set up and then have the cash to wire and purchase a house. Meanwhile, they were able to, set up their home in Half Moon Bay to get all prepped and ready to sell. And then they sold their house in Half Moon Bay. It was literally maybe about 3 months. It was much shorter than we anticipated, which was great. And then they took that capital, paid off that loan, and their portfolio didn't miss a beat.
The typical person would take the $500,000. They might be paying capital gains and they buy that investment. Now their asset value is now still 1 million. It was 1 million that you took 500,000. You bought that house that's worth 500, but your account's now half. So you still only have an asset worth a combined asset worth $1 million. The collateral, the leverage side is I borrow 500,000 against my 1 million at a rate between 4.64 and 6.14. All right. And then I buy that asset for cash in essence. Now I still have the 1 million and I have the $500,000 asset. My combined asset value, instead of being 1 million, is now 1.5 million. Here's the juicy part. So let's just say the margin loan rate on that asset is 6%. But now let's say the account is averaging 8% dividends, interest, and return on investment. That actually means that your investments are paying the 6% interest and 2% additional is paying down the debt. So in essence, you're buying that asset. You've increased your worth by a $500,000 home, albeit with no out-of-pocket payment, and your investments are paying down the loan. The far better strategy is to borrow against your own asset,
borrowing from
to buy the other asset. In worst case scenario, you just sell the collateral and you just end up having truly paid cash for the property anyway.
This is a reason why you can call us at 916-967-3500. We work with our clients' CPAs, accountants, estate tax attorneys to make sure that everything makes sense for your picture.